The U.S. Federal Reserve conducts annual stress tests to assess the resilience of the nation's largest banks in the face of severe economic downturns. These tests are crucial for ensuring the stability of the financial system and preventing a repeat of the 2008 financial crisis. The tests simulate hypothetical adverse economic scenarios, such as a deep recession or a stock market crash, and analyze how banks would fare under such conditions. The results of these stress tests provide valuable insights into the health of the banking sector and help regulators identify potential vulnerabilities. This year's stress test painted a concerning picture, revealing that the biggest U.S. banks are more vulnerable now than they were a year ago. The test results highlighted the potential for significant losses in a severe recession, raising concerns about the ability of some banks to withstand a major economic shock. The Fed's stress tests are not merely academic exercises, they have real-world implications. The results can influence regulatory decisions such as capital requirements and dividend payouts, and can impact investor confidence in the banking sector. Therefore, understanding the findings of these tests is crucial for anyone interested in the health of the U.S. economy and the global financial system. The 2024 stress test in particular has garnered significant attention due to its sobering projections and the implications for the future of banking regulation. The Federal Reserve's 2024 stress test revealed that the 23 largest U.S. banks could collectively lose up to $685 billion in a severe recession. This staggering figure represents a significant increase from the $541 billion loss projected in last year's test. The hypothetical scenario used in this year's test included a 40% decline in commercial real estate prices, a 38% drop in stock prices, and a surge in unemployment to 10%, Michael Barr. These losses would primarily stem from loan defaults, particularly in areas like commercial real estate, credit cards, and corporate loans. The test results underscore the interconnectedness of the financial system and the potential for losses to cascade across different asset classes. The fact that projected losses have increased so dramatically from last year is a cause for concern and suggests that the banking sector may be more vulnerable to shocks than previously thought. The Fed's stress test is not a prediction of an imminent recession, but rather a tool to assess the resilience of banks in the face of extreme economic stress. However, the results serve as a stark reminder of the potential consequences of a severe economic downturn. They also highlight the importance of strong capital buffers and prudent risk management practices for banks. The $685 billion loss figure is a headline-grabbing number, but it's crucial to understand the context and the underlying factors driving these projections. The increase in projected losses compared to last year can be attributed to a combination of factors, including changes in bank portfolios, the economic outlook, and the specific scenario used in the test. The 2024 stress test results revealed a notable increase in projected losses compared to the previous year. This year's test projected collective losses of $685 billion for the 23 largest U.S. banks, a significant jump from the $541 billion projected in 2023. This increase in potential losses highlights the growing vulnerability of the banking sector to economic shocks. Several factors contribute to this heightened vulnerability. One key factor is the changing composition of bank loan portfolios. Banks have increased their exposure to riskier asset classes, such as commercial real estate and leveraged loans in search of higher yields. This shift towards riskier assets has made banks more susceptible to losses in a downturn. Another contributing factor is the uncertain economic outlook. Inflation remains elevated, interest rates are rising, and geopolitical tensions persist, creating a volatile economic environment. This uncertainty increases the likelihood of unexpected shocks that could impact bank balance sheets. The Fed's stress test incorporates these economic uncertainties into its hypothetical scenarios, resulting in higher projected losses. The year-on-year comparison of stress test results underscores the dynamic nature of the financial system and the importance of continuous monitoring and adaptation. The increase in projected losses should serve as a wake-up call for banks to review their risk management practices and ensure they have sufficient capital buffers to withstand potential shocks. The surge in projected losses in the 2024 stress test can be attributed in part to increased risk-taking by banks. In the pursuit of higher profits, many banks have increased their exposure to riskier assets, such as leveraged loans and commercial real estate. Leveraged loans are loans made to companies with significant debt, making them riskier than traditional corporate loans. Similarly, the commercial real estate market has experienced rapid growth in recent years, with some analysts expressing concerns about a potential bubble. This increased risk appetite among banks has made them more vulnerable to losses in the event of an economic downturn. If the economy were to contract sharply, defaults on these riskier loans could surge, leading to significant losses for banks. In addition to increased risk-taking, rising expenses have also contributed to the higher projected losses in the stress test. Banks are facing upward pressure on expenses due to factors such as wage inflation, investments in technology, and regulatory compliance costs. These rising expenses are squeezing profit margins and making it more challenging for banks to absorb losses in a stressed environment. The combination of increased risk-taking and rising expenses has created a more challenging operating environment for banks. The Fed's stress test highlights the importance of banks carefully managing their risk appetite and controlling expenses to ensure they remain resilient in the face of potential economic headwinds. So, let's dive into the complexities of the stress test results. On one hand, they highlight the resilience of the banking sector. On the other hand, they reveal vulnerabilities that need addressing. It's a double-edged sword, really.
Our high loan loss rate is, well, a significant concern. It underscores the challenges we face in maintaining stability, especially in turbulent economic times.
Indeed, the high loan loss rate at Discover Financial Services serves as a stark reminder of the looming threats to bank stability. It's a critical issue that cannot be ignored.
JP Chase has performed admirably in the stress test, showcasing our strong capital position and risk management practices.
Despite our challenges, we are committed to improving our financial health and addressing the high loan loss rate.
At Capital One, our performance in the stress test was solid, and we are optimistic about our proposed acquisition of Discover. It presents a unique opportunity for growth.
Charles Schwab's low loan loss rate is a testament to our prudent lending practices and robust financial strategies.
The performances of JP Chase, Discover Financial Services, Capital One, and Charles Schwab in the stress test offer a comprehensive view of the sector's strengths and weaknesses. Each institution faces its own set of challenges and opportunities, shaping the future of banking. In light of these findings, there is a growing call for enhanced oversight and regulation. The stress tests have revealed vulnerabilities that must be addressed to ensure the stability of the financial system. Moving forward, it is crucial for regulators to remain vigilant and proactive in their approach. The banking sector faces both challenges and opportunities in the current economic climate. While the stress tests have highlighted areas of concern, they also underscore the resilience and adaptability of the banking system. By addressing these challenges head-on, banks can position themselves for sustainable growth and stability. Despite the higher collective losses revealed in the stress tests, the U.S. banking system has demonstrated remarkable resilience. The ability of banks to withstand severe economic shocks is a testament to the strength and robustness of the regulatory framework. This resilience is essential for maintaining confidence in the financial system. As we navigate through uncertain times, it is imperative for both regulators and financial institutions to remain vigilant. Continuous monitoring and adaptive strategies are key to mitigating risks and ensuring the stability of the banking sector. By staying ahead of potential challenges, we can safeguard the financial system for the future.